Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at D-Wave Quantum.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today, we are looking at a scenario that honestly feels like a glaring contradiction.
Oh, absolutely. It's a massive puzzle.
Right. So imagine stepping back, and looking at a technology firm where the headline numbers tell one story, but the underlying mechanics tell a completely different, like almost shocking one.
Yeah, if you just glance at the top-line data for this quantum computing firm right now, you might just completely dismiss it.
Because on paper, they just missed their revenue estimates.
Exactly. But when you look beneath the surface, they are sitting on an unbelievable mountain of cash and securing future contracts that, frankly, just boggle the mind.
Which is exactly the kind of disconnect we love to find, right?
Right, because that disconnect creates a structural opportunity for you as an investor. Our goal today is to cut through all that noise.
And there is a lot of noise. I mean, if you look at the landscape of analyst ratings right now, it is complete chaos.
Total chaos. You have some analysts issuing these really aggressive buy ratings while others are, practically screaming from the rooftops to sell.
So to navigate this for you, we need to focus heavily on a very specific financial mechanic, which is the bookings to revenue lag.
Yes, understanding how that lag basically manipulates the current stock price is going to help us determine if this setup is a classic swing trade opportunity.
Right, a setup for wealth building over, say, the next 3 to 4 months.
Exactly. So let's start with the money. Before we even touch the underlying quantum technology.
Which we are definitely going to get into because it's fascinating.
Oh, it really is.
Yeah.
But we have to establish the financial baseline first, because right now the headline numbers are actively deceiving algorithmic trading bots and casual investors alike.
Let's look at the fourth quarter of 2025. Their recognized revenue came in at $2.75 million.
Which missed Wall Street estimates of $3.74 million.
Right. And you see a miss like that, the trading algorithms immediately react, the stock drops, and, well, retail investors panic.
But here's the critical data point that those algorithms completely miss. Their fourth quarter bookings hit $13.4 million.
Wow. Wait, so that is was that 471% sequential increase from the previous quarter?
Yep, 471%. And it accelerates from there, too. Moving into the first quarter of 2026, their bookings have already crossed $32.8 million.
That's insane. Keep in mind, their entire full year 2025 revenue grew 179% to $24.6 million.
So they're booking more in a single quarter than they recognized in an entire year of hypergrowth.
Let's break that down, because that distinction between a booking and recognized revenue is basically the central pillar of the bullish thesis here.
It is. So when a customer signs a contract for a commercial quantum computing service, that is a booking. The money is committed. The deal is totally locked in.
Right. But under standard accounting principles, a company cannot just stamp that cash onto their income statement as recognized revenue.
Exactly. They can't claim it until the actual service is delivered and completed over time.
It's sort of like managing an ultra-exclusive, high-demand event venue.
Oh, that's a good way to look at it.
Yeah. Imagine a stadium sells out every single ticket for a massive multi-day summer concert series, right? And all those tickets are purchased in January.
Okay, I see where you're going.
If you look at the venue's official revenue statements in February, they look completely flat. The cash register, for accounting purposes, hasn't recorded the event because the concert hasn't happened yet.
Right, but the underlying business is absolutely booming.
Exactly. The demand is locked in. Anyone shorting the venue's stock in February just because the quote-unquote revenue looks low is walking right into a trap.
That venue analogy perfectly captures the danger of shorting this stock based on just a superficial reading of the income statement.
Yeah, it's just a timing lag.
Exactly. And this leads directly into the most critical layer of their financial security, which is the balance sheet.
Right, because in the world of pre-profit emerging technology, your biggest enemy isn't actually your competitors.
No, it's time. The single biggest risk you face as an investor in this space is insolvency.
Just the risk that the company simply runs out of capital to keep the lights on before their breakthrough tech achieves mainstream adoption.
Precisely. But D-Wave Quantum has entirely neutralized that threat. They closed out the fiscal year with this absolute fortress balance sheet holding $884.5 million in liquid cash and assets.
Which is a 397% increase year over year. Nearly $1 billion in liquid capital for a company at this stage. is, I mean, it's almost unheard of.
It really is rare.
And what stands out to me isn't just the raw size of that war chest, but how incredibly clean the books are. Their debt-to-equity ratio is sitting at just 0.04.
Yeah, they essentially have zero debt leverage weighing them down,
On top of that, they boast a current ratio of 42.38.
which is a staggering metric.
Think about what that practically means for a second. For every single dollar of short-term financial obligation they have to pay over the next 12 months, they have over $42 in cash and liquid assets sitting right there to cover it.
Right. They are, for all intents and purposes, financially bulletproof in the short term.
So when you have that kind of liquidity, it shifts the entire operating strategy of the company, doesn't it?
Completely. It means management isn't sweating next month's payroll. They are funding a massive, sustained path to profitability.
They have already committed to a 15% quarterly increase in research and development spending all the way through 2026.
And typically, when a pre-profit tech firm aggressively ramps up R&D like that, they are forced into secondary offerings.
Right. They have to print and sell new shares to raise the capital.
Exactly, which just dilutes your ownership stake as an existing investor.
But because they are sitting on this $884.5 million mountain of cash, they can fund their own explosive technological growth without even touching shareholder equity.
It's a huge advantage.
Okay, so the financial runway is clearly paved. But that brings us to the actual hardware.
The fun stuff.
Exactly. With a fully funded, incredibly aggressive R&D budget, what exactly is this company building that has secured over $32 million in future contracts from massive global entities? We're talking Volkswagen, Lockheed Martin, and BBVA.
To understand that, we really need to look at their dual-pronged technological moat. Currently, they are the only provider in the global market actively commercializing both annealing quantum computers and gate model quantum computers at the exact same time.
Okay, wait, I am going to push back on that strategy.
Sure, go ahead.
Because when I look at the sheer complexity of building quantum computers, focusing on two entirely different architectural paradigms sounds like an incredibly fast way to burn through that billion-dollar cash pile.
It sounds counterintuitive, yeah.
Right. Like, why spread your engineering teams thin? Why does a company need to build both an annealing system and a gate model system simultaneously?
It is a totally fair critique, but it really comes down to a bridge strategy. A bridge between their long-term vision and their immediate commercial survival.
Okay, explain that.
Well, gate model systems represent the sort of holy grail of quantum mechanics. These are the fault-tolerant universal machines that most people actually imagine when they hear the term quantum computing.
So these are the ones that will eventually, like, break modern cryptography and simulate complex pharmaceutical molecules atom by atom.
Exactly. However, they are highly prone to environmental noise and error rates, meaning commercially viable, large-scale gate model systems are still years, if not decades, away.
Ah, so they aren't making money on those yet.
Right. Annealing, on the other hand, is a highly specialized, hyper-focused form of quantum computing designed to do basically one thing: solve incredibly complex optimization problems.
And unlike the gate model systems, annealing technology actually works today.
Yes. So the strategy is essentially using the immediate tangible revenue from the annealing systems to fund the massive long-term R&D required for the gate model future.
Okay, that makes sense. To help you visualize this, let's talk about how annealing actually works compared to the classical computers sitting on our desks.
I love this analogy.
So, if I need to find the lowest point in a massive, sprawling mountain range, a traditional computer has to essentially walk down every single path, one by one. It measures the depth, climbs back up, and tries the next path.
Which takes an eternity.
Exactly. Quantum annealing, however, acts more like flooding the entire mountain range with water.
Right.
The water naturally and instantly flows to the lowest possible point. It solves the optimization problem through the fundamental laws of physics rather than brute force calculation.
That is a phenomenal way to picture it, and that physical advantage is playing out in the real world right now.
Yeah, D-Wave Quantum recently announced that their new Advantage 2 system was put to the test against a massive traditional supercomputing cluster.
We are talking about an array of 80 state-of-the-art NVIDIA H100 GPUs working alongside 480 CPU cores.
And in specific optimization tasks, the quantum annealing system completely outperformed that entire massive traditional setup.
Beating 80 top-tier GPUs is just a staggering metric.
It is, but let's be critical here for a second. Are we just talking about an isolated, highly controlled lab experiment designed to make the tech look good? Or is there an actual commercial use case that scales?
Oh, there is a massive commercial use case. And it happens to intersect with the single biggest narrative driving the global markets right now.
Which is the energy constraints of artificial intelligence.
Exactly. There is a very loud whisper circulating through the tech industry that quantum annealing could be the specific skeleton key needed to solve the severe energy efficiency bottlenecks we are seeing in AI model training.
This is a huge point for you to consider. Because everyone is focused on the software side of AI, but the physical infrastructure is literally hitting a wall.
It is. Training these massive language models requires running tens of thousands of GPUs continuously for months.
And those processors work by switching billions of microscopic transistors on and off, which generates a massive amount of heat. They require immense cooling systems.
Right. We are reaching a point where AI data centers are literally maxing out the electrical grids of entire municipalities.
Traditional silicon computing is hitting a thermal and physical limit.
You've hit the nail on the head. The power grids simply cannot support the exponential scaling of traditional AI compute.
But quantum annealing, returning to that analogy of water finding the lowest point in a valley, operates differently.
By leveraging quantum mechanics to find the lowest energy state of a given problem, it could hypothetically optimize the complex routing, weight distributions, and parameter tuning of massive AI models.
And doing all of that using just a fraction of the electricity required by a traditional GPU cluster.
Exactly. And to prove this isn't just some ivory tower theory, look at the upcoming Semaphore World Economy Summit scheduled for April 15th, 2026.
Oh, right. The CEO of D-Ways Quantum is specifically slated to present there on the geoeconomics of artificial intelligence.
Yes. When you connect this rumored AI energy solution to their dual platform strategy, the sudden steep acceleration in their commercial adoption curve makes complete logical sense.
Okay, so let's synthesize the bullish case so far.
Yeah.
They are outperforming massive arrays of top-tier GPUs in specific tasks. They are positioning themselves as the potential savior to the AI energy crisis, and they have nearly $1 billion in cash to weather any storm.
Sounds perfect.
Right.
Huh?
So if all of that is reality, why is there such an aggressive cohort of market analysts screaming to sell this stock?
Well,
I mean, you log on to Seeking Alpha right now, and you will find authors rating it a strong sell with a price target as low as 4.13. Clearly, they see something terrifying.
they do. The bearish arguments generally fall into two distinct camps. You have extreme valuation disconnects and severe supply chain vulnerabilities.
Okay, let's look at the valuation first.
The current stock price is commanding an incredibly high forward price-to-sales multiple. Depending on which forward estimates you use, the stock is trading anywhere from 95 times to an astronomical 387 times its projected sales.
Wow. Which, in the traditional software world, is completely absurd.
Totally absurd.
A highly successful, rapidly growing software company might trade at 10 or 15 times sales. Trading at 387 times sales implies that the market has already priced in absolute flawless execution for the next 10 years.
Yeah, the moment they stumble, that multiple collapses.
It does. The bears argue that regardless of how revolutionary the underlying technology might be, the stock price has completely detached from their current execution reality.
The counter-argument to that, however, is the fortress balance sheet we talked about. Typically, companies trading at those hyper-speculative multiples are doing so on pure narrative alone.
Right. They rarely have $884 million sitting in the bank alongside an actual verified 179% growth in yearly revenue.
Exactly. But the second bear argument carries much more immediate weight, and that involves their physical supply chain.
Right. Let's unpack the supply chain drama because this is where the plot really thickens.
It does get dramatic here.
When analyzing their hardware dependencies, you see that one of their key chip suppliers is a company called Skywater Technology.
Yes.
And recently, their direct market rival, IonQ, acquired Skywater Technology.
Yeah.
Wait, so if I have this right, their biggest competitor now literally owns the manufacturing facility that produces their critical hardware components.
That is correct.
That sounds like a catastrophic vulnerability. It's like Ford owning the only factory on Earth that makes steering wheels for Toyota.
It's a great comparison.
How is that not an absolute immediate deal breaker for anyone considering this stock?
On the surface, it looks like a brilliant strategic checkmate by a competitor. Having a critical hardware dependency on a direct rival introduces an immense level of operational risk.
Right. It forces investors to question the actual resilience of their manufacturing pipeline.
However, this is exactly where that $884.5 million cash reserve proves its ultimate worth.
Because having that level of capital grants management, incredible strategic agility.
Exactly. Furthermore, the market is currently digesting a very strong rumor that D-Wave Quantum is actively preparing to acquire a company called Quantum Circuits.
Oh, which would be a massive move toward rapid vertical integration.
Exactly the point. With nearly $1 billion in liquid capital, they are not permanently tethered to the mercy of Skywater Technology or their rivals.
They have the immediate financial power to diversify their supply chain, integrate brand new fabrication partners, or completely internalize the manufacturing process through an acquisition like Quantum Circuits.
Right. That cash pile is acting as a massive insurance policy against competitor sabotage.
So we have an incredible tension building here. On one side, we have this massive backlog of bookings, a fundamentally altering narrative around AI energy consumption, and a pristine balance sheet.
And on the other side,
We have an eye-watering valuation multiple and a highly compromised, dramatic supply chain situation.
it's quite the standoff.
Knowing these extreme polarities, how is the broader market pricing this tension right now? Let's get into the actual mechanics of the trade.
Well, the price action recently has been volatile, dictated heavily by broader macroeconomic winds. Back in March, the stock took a brutal 23.2% dive.
But that sell-off wasn't necessarily a reaction to the company's fundamentals, right?
No, not at all. It was rather a reflection of broader geopolitical fears and a sudden wave of risk aversion sweeping through the markets.
Because whenever institutional money gets scared, highly valued, pre-profit technology stocks are always the very first assets to be liquidated.
Always. But then we saw a violent shift. On April 14th, 2026, the stock staged a very sharp 15% relief rally.
And that specific surge seemed to be catalyzed by the announcement of a new collaborative partnership with Cambridge University.
Right, combined with a general return of bullish momentum to the overall quantum sector.
From a technical analysis standpoint, what you were looking at is a classic coiled spring setup.
Yeah, right now the stock is currently trading below both its 50-day moving average of 17.53 and its 200-day moving average of 24.61.
A coiled spring setup occurs when a stock is artificially suppressed by macro fears, building up this intense pressure.
Exactly. That high-volume 15% snapback on April 14th is a strong technical indicator that the immense downward selling pressure might finally be exhausting itself.
But, technical charts only tell us what has already happened. To predict where this stock is moving next, we have to follow the smart money.
We need to look really closely at the divergence between what company insiders are doing versus what institutional heavyweights are doing.
I always find this divergence fascinating. Over the last 3 months, the insiders, so the executives and board members actually running the day-to-day operations, sold off 72,898 shares.
Which nets them roughly $1.75 million in personal profits.
Right. But during that exact same 3-month window, the massive financial institutions have been accumulating shares at a really aggressive pace.
Very aggressive. AQR Capital Management increased their overall position by an astonishing 201% in the first quarter alone.
Wow.
Yeah. And the Royal Bank of Canada also raised its holdings by nearly 60%.
So let's synthesize this dynamic for you. You have insiders taking a few chips off the table after a historical run, but the multi-billion-dollar funds are happily buying up the fear.
That specific pattern is actually very common in hypergrowth stocks and provides a strong signal.
Really? How so?
Well, for insiders, taking a couple $1 million off the table is often just a matter of personal liquidity and risk management. A massive portion of their total net worth is tied up in a single asset, so taking profits is just prudent.
That makes sense.
But when an institution with the analytical resources of AQR Capital aggressively triples its stake, it signals an immense level of fundamental conviction.
They aren't worried about the short-term noise surrounding the supply chain.
Not at all. They are looking down the calendar at the upcoming catalysts.
And there is the very dense cluster of catalysts approaching. Right around the corner, we have the QBTS Quantum Summit on April 16th, which is an event heavily focused on lucrative government and defense sector contracts.
We also have a stabilizing macro environment. The Federal Reserve holding interest rates steady in that 3.50 to 3.75% range is critical.
Yeah, stable, predictable interest rates act like oxygen for high-growth speculative stocks.
Exactly. But the ultimate catalyst we are eyeing is the upcoming earnings report scheduled for late May or early June.
When you aggregate all of these factors, the technical exhaustion of the sellers, the institutional accumulation, and the macro stability, it creates a robust 7 out of 10 bullish thesis for the stock.
We are looking at a targeted 3 to 4 month horizon here. This is a classic swing trade into earnings play.
So the strategy here is to accumulate shares during the current dip, which is being artificially driven by those valuation fears and supply chain headlines, and hold that position into the late May or early June earnings call.
Yes, because that earnings call is when the great accounting trick we talked about finally resolves itself.
Right, that massive $32.8 million first quarter booking haul we discussed at the top of the show won't stay booking forever.
No, it has to finally start converting into recognized revenue on the official income statement.
And when those delayed multi-million-dollar bookings finally cross the threshold and hit the recognized revenue line, the prevailing bearish illusion of slowing growth is going to shatter entirely.
That sudden, verified explosion of top-line revenue could easily trap the short sellers who have been heavily betting on a fundamental collapse.
And when short sellers are trapped by an unexpectedly positive earnings report, they are forced into the open market to buy back shares to cover their losing positions.
Exactly. That forced buying sparks a cascading short covering rally, driving the price up exponentially.
The entire play relies on positioning yourself ahead of the moment when the accounting finally catches up to the commercial reality.
It is entirely an exercise in timing the lag between the booking phase and the recognition phase.
It's brilliant, really. But before we wrap up today's analysis, I want to pull the lens back a bit. We have spent this time heavily dissecting the mechanics of the trade, the supply chain drama, and the balance sheet data. But we need to consider the broader, long-term implications of this underlying technology.
I think the most vital question for you to ponder as an investor is really one of classification.
Okay, what do you mean by that?
Well, right now, the global markets view quantum computing as a highly speculative, incredibly niche hardware play.
Right.
But if D-Wave Quantum's unique annealing technology truly does prove to be the skeleton key that unlocks the massive power consumption limits of artificial intelligence.
If their hardware is what ultimately allows AI data centers to scale globally without melting our municipal power grids.
Exactly. Then the market is entirely mispricing this entire sector.
Should we stop looking at these firms as experimental computer hardware companies and begin valuing them as the future indispensable backbone of global energy infrastructure?
That is the big question.
And that is a profound question to leave you with today. Because if they successfully transition from being viewed as a niche computing play to an essential global energy play, their entire valuation model completely flips on its head.
It changes everything.
It really does. Thank you for joining us for today's wealth building discussion and market analysis. Stay curious, keep looking past those deceptive headline numbers, and always analyze the true mechanics operating beneath the surface. We will see you next time.